The market's been, well, a bit of a roller coaster lately, and today we're diving into some of the forces that are driving these ups and downs. We've got a fresh market deep dive report dated November 20th, 2024, and it's highlighting a lot of uncertainty just swirling around.
Yeah, that's right. There's a lot to unpack. We've got big tech earnings, retail giants sending mixed signals, and the looming question of, well, who will be appointed Treasury Secretary in the new Trump administration?
Yeah, it seems like everyone's holding their breath a bit, just waiting to see what happens next.
Exactly. And that anticipation, that uncertainty is a big part of what's driving the market's mood right now.
Okay, so let's jump right in. Let's start with Nvidia. They just released their earnings report. And on the surface, it looks pretty amazing. They absolutely smash earnings expectations.
But then their guidance for the next quarter wasn't quite as stellar as some analysts were hoping for. And that little detail caused a bit of a ripple effect.
Right, their stock initially dipped in after-hours trading, which seems kind of counterintuitive when a company just blows past earnings estimates. Can you help me understand why that happened?
Sure. Remember, the market is always looking ahead, always trying to anticipate future performance. And Nvidia's guidance, which is basically their own forecast for the next few months, suggested that their growth might be slowing down, just a tad.
So even though their current performance is strong, the possibility of a slightly less explosive future, that spooked investors.
Precisely. And it's important to note that Nvidia is often seen as a bellwether for the broader tech sector. So any hint of a slowdown, even a slight one, can make investors nervous about the tech industry as a whole.
That makes a lot of sense, especially considering Nvidia is, well, they're in the midst of a transition, moving to their new Blackwell chips. There are always some unknowns when a company goes through a major shift like that.
Absolutely. And the market doesn't like unknowns. They crave certainty, predictability. So even though demand for Nvidia's new chips is strong, the potential for production challenges or hiccups during this transition adds another layer of uncertainty.
And uncertainty is basically kryptonite to the market, right?
Pretty much. It makes investors hesitant. And that hesitation can translate into stock price volatility, as we saw with Nvidia's initial dip. And this whole situation is even more interesting when you consider the whisper numbers.
Okay, I've heard that term before, but refresh my memory. What exactly are whisper numbers?
Whisper numbers are basically unofficial, super optimistic earnings predictions that circulate among some investors. And in Nvidia's case, some folks were whispering about guidance as high as $39 billion. When the actual guidance came in lower, it created a bigger gap than anticipated, adding fuel to that initial stock dip.
So it's not just about the actual numbers, it's about how those numbers measure up against expectations, whether they're, official analyst predictions or those whisper numbers floating around.
Exactly. Expectations play a huge role in market psychology. And that's something we're going to see come into play again as we analyze what happened with Target.
Okay, so Target, that's a whole different ballgame. We're moving from the high-flying world of tech to the more, well, grounded realm of retail.
Right.
What went down there?
Yeah, you could say that. Target's story is really about what's happening with consumers. And that has implications for, well, everyone, really, whether they're, invested in retail or not.
Right, because ultimately consumer spending drives like a huge chunk of the economy. So what's the story with Target? Their stock took a major tumble after their earnings report, right?
It did. It plunged by 21%. And this time, it wasn't just about missing those whisper numbers. They missed actual analyst estimates for both revenue and earnings per share.
Yeah.
Plus, they issued, a weaker than expected forecast for the all-important holiday quarter.
Ouch, that's a triple whammy. But what's driving this underperformance? Is it just the overall economic uncertainty we've been talking about?
That's definitely a factor. But there's more to it. Target specifically called out weaker demand for discretionary items, things like clothing and home decor. That's a sign that consumers might be, tightening their belts and prioritizing essential purchases over those nice-to-haves.
That's interesting, because it paints a very different picture than what we saw with Walmart's recent earnings report. They actually seem to be thriving, attracting higher-income shoppers. Could this mean that Walmart is winning the retail battle right now?
It's certainly possible. Walmart's focus on value and everyday essentials could be resonating more with consumers who are feeling the pinch of, inflation or economic uncertainty. While Target, known for its more trendy discretionary items, might be seeing some of its core customer base pulling back a bit.
So is this a sign of a bigger shift in consumer behavior? Are we moving away from those discretionary splurges and kind of hunkering down, focusing on the essentials?
That's the million-dollar question, isn't it? And it's something investors will be watching very closely, especially as we head into the holiday season. The performance of retailers like Target and Walmart during the holidays is a key indicator of overall consumer, confidence and spending patterns.
Yeah, it makes you think twice about your own holiday shopping list, right? Maybe hold off on those extra decorations and focus on the practical gifts this year.
That's a smart approach. It's always wise to be mindful of, well, broader economic trends and adjust your own spending accordingly.
Okay, so we've got these two big players, Nvidia and Target, telling somewhat different stories about where the market might be heading. But what about the overall market's mood? How did it react to all this news?
Well, interestingly, the broader market reaction was pretty muted. The S&P 500 remained virtually flat. The Dow Jones Industrial Average inched up slightly, while the Nasdaq Composite, which is, heavily influenced by tech, dipped just a bit.
So it's almost like the market is frozen, trying to process all this conflicting information. Good earnings from Nvidia, but with a touch of caution. Weakness in retail, but maybe a shift towards value over discretionary spending. What are investors supposed to make of all this?
It's a puzzle, that's for sure. And adding another piece to this puzzle are interest rates. We saw the yield on the 10-year Treasury note rise during the day.
Okay, I always hear about those 10-year Treasury yields, but to be honest, I don't fully grasp why they matter. Can you break it down for me?
Sure, essentially when that yield goes up, it means investors are demanding a higher return for lending money to the government. Think of it as a sign that they see more risk on the horizon. And when interest rates rise, as they tend to do when yields climb, it makes borrowing more expensive, for companies and consumers alike. That can put a damper on economic growth.
Ah, so rising yields can be a signal that investors are a bit skittish, and that can have a ripple effect throughout the entire economy.
Exactly, and this ties into the broader theme of uncertainty we've been talking about. We've got inflation still running a bit hot, which the Federal Reserve is trying to control by raising interest rates. But too much too fast could trigger a recession.
Yeah, it's like walking a tightrope. But there's one more big wild card we need to consider, right? The political landscape. President-elect Trump will soon be appointing a new Treasury secretary, and that person will have a huge influence on economic policy.
You got it. The markets hate surprises. And right now, they're anxiously waiting to see who that pick will be and what signals it sends about the direction of economic policy. Will we see more of the same? Or will there be a significant shift?
Man, with all this uncertainty hanging over the market, it's no wonder things are so volatile.
It's definitely a time for cautious optimism. There are some positive signals out there, but there are also plenty of unknowns.
So we've got this backdrop of uncertainty. But there were a few other interesting developments in the market today. Comcast announced they're spinning off some of their cable channels, including, big names like MSNBC and CNBC, and that actually sent their stock up.
Yeah, it's an interesting move. Essentially, they're streamlining their business, focusing on their core strengths like, broadband internet and theme parks. Investors seem to like the idea of a more focused Comcast, betting that it'll unlock value for shareholders.
So maybe a little bit of uncertainty can be a good thing if it forces companies to get leaner and meaner.
Potentially. It's all about adaptation,
Right.
right? The companies that can adjust to changing market conditions, whether it's, increased competition or shifting consumer preferences, are the ones that tend to thrive.
Speaking of adapting, another company that caught my eye today was Chewy, the online pet supply retailer. They got a boost from a positive analyst rating, apparently due to improving pet adoption trends.
Yeah. And this ties back to what we were discussing earlier about consumer spending. Even when people are tightening their belts, they're still willing to spend on their furry friends. So while discretionary spending might be slowing down overall, there are always pockets of resilience, sectors that buck the trend.
That's a good reminder that even when things feel uncertain, there are still opportunities out there. But I'm curious, what about those companies that seem to be doing everything right, but still get punished by the market? We saw that happen with Palo Alto Networks today. They're a cybersecurity firm, and they beat earnings estimates, but their stock still went down.
Yeah, it's a classic case of, well, good news isn't always good enough. Sometimes the market has already priced in strong earnings. And if a company's guidance doesn't exceed those already high expectations, investors might sell off the stock, even if the underlying performance is solid.
So it really is all about managing expectations. and making sure you're not getting ahead of yourself, even when things look great on the surface.
Exactly. That's why it's so important to stay informed, do your research, and really understand the dynamics driving individual companies and the market as a whole.
All right, so we've covered a lot of ground here. We've talked about Nvidia, Target, Comcast, Chewy, Palo Alto Networks, a whole mix of companies and market reactions. It's been fascinating to see how these individual stories, they kind of fit into the larger puzzle of the current market climate.
Absolutely. And I think it highlights a crucial point. Even with economic data pointing towards strength, these undercurrents of uncertainty, whether it's around inflation, interest rates, or the upcoming political transitions, can still create, well, a lot of volatility.
So what's the big takeaway for our listener? What should they be thinking about as they navigate these choppy market waters?
Well, first and foremost, don't panic. Volatility is a natural part of the market cycle. Second, remember that investing is a long game. Focus on your long-term goals and don't get too caught up in the, day-to-day fluctuations. And finally, stay informed. The more you understand the forces that are shaping the market, the better equipped you'll be to make sound investment decisions.
Well said. Knowledge is power, especially when it comes to investing. So keep learning, stay curious, and as always, thanks for joining us on this deep dive into the fascinating world of the markets.